Well, I think it's probably one third, and one third being technical, that 1770 level in the S&P. Once we broke that, we had stopped there several times last week. We broke that and we went into a spiral. The ISM is probably another third. And then the concern about the emerging markets. If you look at the yield on the 10-year, that's an important barometer today because it tells you that there are other problems about, and most of that is the emerging market.
I don't think this one's going to be over until we're about 6% undervalued and we have widespread pessimism. So it's going to take time. I think the real question, the question you're asking, is this just going to be a correction? Is it going to be a 10% correction? Well, it's going to be at least that. Is it going to be something worse, a bear market that's accompanied by a recession? My answer to that question is really that it's only going to be a correction in an ongoing bull market. And the reason I say that, Sue, is it's very hard to make the case that the U.S. economy in 2014 or 15 is going to go into a recession.
We were buying General Motors. We own it higher. It's down 15% from its highs, so not happy there.
Buying more or no?
Buying more today. I think the yield now gets kind of interesting because you're yielding about 3.4%. Remember, when they lowered guidance a couple of weeks ago, they also announced a dividend that was better than expected. I like the restructuring. I like the new product cycle, the truck product cycle for this company versus Ford, where they have to launch all these out this year. So their costs are going to be higher. They don't get that leverage. And the stock really is kind of less in favor versus Ford at this point, in my opinion. So that's the one that we've been buying and looking at Johnson Controls as well. Auto parts, right? A disappointing quarter for sure, but down 12% in 2 weeks' time. I think that's way over.
The key point is that all risk assets, including emerging markets, are heavily reliant upon dollar funding, and the cost of dollar funding has gone up exponentially in the last, 1 month at least, if not 2 months. And of course, as the divide between local currency rates and the cost of dollar funding goes up because of the Fed taper, emerging markets are going to suffer.
Cost of money's gone down.
But you're not pricing off the Treasury. You're pricing off the short-term cost of dollar funding. If you're taking a local currency position in dollar Turkey, dollar Rand, dollar ZAR, you're taking a 3-month funding position, not a 10-year funding position. It's because of sentiment first, but rates second. And US dollar rates are definitely going up. The cost of funding is going up. But more critically, and far more importantly, the divide between local currency ruble rates and dollar rates are up. Rand rates and dollar rates are up. Turkey rates and dollar rates, they're up. And that's what's causing this hemorrhaging, which could become more significant as it has previously.